Whisper words of wisdom. Let it be, let it be. For you Beatles fans out there, hi, Dr. Scott at your service. Here to kind of bring a conclusion to chapter 1 with understanding financial statements and how they are related. I'm going to take a quick share the screen and move over to PowerPoint. That's going to give you some insight into what we're going to cover. First of all, we're going to be going after our 4 financial statements. We'll talk about the balance sheet, the income statement, the statement of retained earnings, and the statement of cash flow. This course will be heavy into the balance sheet and income statement. But the bottom line that you want to walk away with from this particular lesson is a fundamental accounting equation where assets equals liabilities plus equity. And we'll go define those terms in a few minutes. I want to go ahead and take a look at the 4 statements that we're going to be analyzing or including. First is the income statement. Hey, do we make money? Revenue minus expenses equals net income. We'll see that in a minute. But this describes a company's revenues and expenses, calculates net income or loss. We don't always make money, although we'd like to. And specifically over a period of time. That's kind of important. We'll talk about the differentiation between a period of time and a point in time. Then we have the statement of retained earnings. So these are changes, something called retained earnings, which is a portion on the balance sheet. It's found in the equity section of the balance sheet. We'll see how that relates. And we add our net income, we take away our dividends, and we see what the business is retaining and keeping with the business. And then we get to the balance sheet. The balance sheet is also known as the statement of financial position. The 3 things, assets, liabilities, and equity, are going to be found there. And that is where our accounting equation comes into play. And finally, we have a statement of cash flows. We have inflows and outflows, cash receipts and cash disbursements. And this is over a period of time as well. And it's 3 categories that we'll mention: operating, investing, and financing. Cash flow from operations, cash flow from investments, and cash flow from financing. Let's go back to our balance sheet and talk about some terminology. Notice in the red, we've got a balance sheet that has 3 main categories. We have assets, we have liabilities, and we have equity. And under the assets, we're going to talk about what assets are. Assets are basically things we own. So that can be all kinds of stuff, anything we can convert to cash. So what kind of things are there that we own? Well, we own equipment. We can sell it. We own inventory. We can convert that to cash when we sell it. We also own something that we're going to call accounts receivable. That's when people pay their bills. They're going to convert that to cash. We're going to get money for things they owe us. Those are receivables. We also might have something called prepaids and deposits. What the heck is a prepaid? Well, if all of a sudden you go out and you buy a plane ticket and you say, you know what, I'm going to spend $500 on a plane ticket to go to London, and then they cancel the flight. Does that money come back to you? Well, we hope so, if they cancel it, not if you just don't show. And what's going to happen is we can convert that to cash if the flight doesn't happen. It's an asset. It's just something we own. We might have buildings. We might have vehicles. We have all kinds of things that we can purchase or acquire in some way, shape, or form, but ultimately can sell and convert to cash. So assets are things we own as opposed to liabilities, which are things we owe. So we owe money. We've got to pay. We have obligation to pay. We may take out a mortgage. So we've got a mortgage payable on that house or on that building that we purchased. So what are we going to happen? We're going to have an asset, and I'm going to have a building right here. Let's see if we can draw a little bit of line here, and we'll go ahead and have a building, $100,000 worth. We're going to have a mortgage payable, also $100,000. We've got something called the accounting equation. We need to be in balance every time. Assets equals liabilities plus equity. So we got $100,000 in a building. We got $100,000 in a mortgage. We didn't make any deposits or down payment. We're good to go. We're in balance. What happens if we pass around the hat and we raise some cash? We sell some equity. Maybe we have $10,000 in equity, common stock, and $10,000 in cash. We're still in balance. We've got $110,000 liabilities plus equity. We've got $110,000 in assets. So let's go back down to our flow and see what we're doing here. And we have our assets. We have some liability. Let's talk about some more liabilities we might have. Liability might be a bond is payable. We actually borrow money from investors instead of just borrowing in with equity in a building or a house. We actually issue bonds and say, we're going to pay you 5% a year for the next 20 years. And when it's all done, we'll pay you back your principal. You might go to a bank and get maybe a notes payable. You take a loan from the bank or a bank loan or something. Again, it's money we owe that's going to be used by us to pay for stuff. The third category we have is equity. And bottom line, equity is the remaining ownership interest. Well, the accounting equation, as you recall and you saw, assets equals liabilities plus equity. And we do some fancy algebra, razzle dazzle. Assets minus liabilities equals equity. Nothing fancy, just took liabilities from both sides of the equation. So if I have monies in equity, that's our equity investment. Now here I have it made up of three things: common stock, additional paid-in capital, and retained earnings. What the heck is retained earnings? Let's talk about retained earnings for a minute. Retained earnings is the earnings or profits that the business has retained. They haven't distributed it in the form of dividends yet, but it is the net income and profits they make. So we can see that we have this assets, liabilities, plus equity, which includes these three things, and we keep that in balance. Let's talk about our income statement. We have an income statement that, I'm going to back this out a little bit. Some of that red stuff. Okay, we have an income statement. Notice on the income statement, we have revenues and expenses. Okay, so revenues normally associated with sales. Expenses are those costs associated with generating those sales. So we take our magic formula of revenues minus expenses, and we have net income, or possibly NL for net loss. If our expenses exceed our revenues, we're in the hole. Not a good place to be, but it happens, especially with a startup. It's normal to run losses when you start a business. It's normal to have losses periodically throughout your career and life as a business. Amazon had losses the first 7 or 8 years in business. Some companies have never made money. Tesla has never made profits. They've had losses every year since they've been formed, probably about 15 years ago. So you have operations that never make money, and that happens. Eventually, you hope to make money. That's the goal in business, is to generate a profit and a return to your stockholders, a return to your investors, folks that own the common stock. Now, I mentioned this point in time and period time stuff is kind of important. So let's talk about that now. I'm going to go ahead, I'm going to zap this right here. And I'm going to talk about, I asked you, what is my rent expense? I said 12/31. I'm going to ask you what my sales, these are all in the income statement items, sales for 12/31, December 31st. And you can say to me, I'm confused already. Do you mean what were my sales on December 31st, one day? Or do you mean the month to date for the month of December? Or the quarter to date, 3 months is a quarter, so October, November, December. Or year to date, maybe January 1st to December 31st. We're back to our it depends. Remember I mentioned the answer to most of my questions is it depends. Well, the key here is understanding that the depends is what period of time are we talking about? It won't make sense to ask, what's my rent expense for one day? You're not going to want to know that. You're going to want to know the month, the rent for the month in December maybe, or the rent so far this year. But the same thing happens on the balance sheet. If I asked you, what's my inventory for year ending December 31? You say, I can't give you a period amount. I can give you what is my inventory on December 31. But if you say, well, what's my inventory for December? Well, December 1st, I got some inventory. December 2nd, I bought some more. My inventory is more. December 3rd, I even bought more, and I've got more inventory. December 4th, I sold a bunch. December 5th, I sold some. Every day, I have a different amount in the value of inventory. So a point in time is what I need to pick. So all my balance sheet items are a point in time. What is my receivables today? What is my value of my inventory today? What is the value of accounts payable? Monies I owe, not accounts receivable, but accounts payable, which is can get confusing sometimes. Payables are things you owe your vendors. I'm going to note that out because I've seen confusion on this. If we say accounts receivable, I abbreviate it AR. AR, money owed to you from customers, as opposed to accounts payable, AP, money owed, it's all money too, owed by you to vendors. Customers and vendors are different folks usually. Customers are the folks that buy from you. Vendors are the things you buy from them, or things you buy from your vendors. And you are their customers, but they're not your customers, they're your vendors. So you buy stuff, you buy inventory, and you sell it. So when you make transactions, you're going to be affecting both maybe you bought inventory. Okay, so, and I owe some money. So I got payables on one side, here are my liabilities. I've got inventory on the other. I'm in balance. On the other hand, I might have sales. And what's interesting, and we'll see how this works, is when I have beginning retained earnings, I get zero. But let's say I have sales of $1,000, $1K here, $1,000 bucks. How is that going to affect? Well, I got paid cash. Let's go with cash came in of $1,000. So we have $1,000 in cash coming in, and I've got sales of $1,000 here. And you say, but Dr. Scott, I'm out of balance. I got $1,000 in total assets. I get zero liabilities and zero equity. And if you are real sharp, you probably looked at this retained earnings statement, and I told you retained earnings is right here. That's what's going to change. So look at this. I've got beginning retained earning of zero. What's my net income? Well, I've got zero in expenses. I've got $1,000 in sales. So what's my net income? Well, 1,000 minus 0 is $1,000. So beginning retained earnings of 0. I add $1,000 in net income. I have 0 that I've issued in dividends, pay back my owners, and I've got a net retained earnings of $1,000 bucks. And this $1,000 is going to go and jump right to there. So now I've got 1,000 in cash and 1,000 retained earnings. We're in balance. Life is good. And life should be good. So if I haven't confused it enough already, this is the relationships between the balance sheet, income statement, statement of retained earnings. The only thing I'll mention about cash flow statements is beginning cash is last year's balance sheet number. Ending cash is this year's balance sheet number, point in time. Key to understand. So let's walk through some of this other stuff. So let's review the accounting equation. We have assets equals liabilities plus equity. You should be getting comfortable with those terms. And notice equity, combination of common stock and retained earnings, which is defined as add revenues minus expenses, net income, minus dividends, gives you retained earnings. Common stock, usually for a corporation, contributed capital, usually for a sole proprietorship, sometimes partnership. But bottom line, this is where revenues expenses fit in. And I jumped to the chase and I said, let's talk about retained earnings. Let's talk about the income statement. This chapter really emphasizes the balance sheet only and imports the income statement data right through here. But I wanted to show you the income statement too in a little more detail so you get a handle on this. Let's walk through a few transactions. So we have an investment by owner. What's happening? $30,000 we collected. An asset went up for 30 grand, and our common stock, our equity went up by 30 grand. Are we in balance? Yep, assets 30, liability 0, equity 30. Cool. So how does that affect our accounting equation? There's the big picture. Assets equals liability plus equity. We know what's going on. We got 30,000 cash and 30,000 equity. Do we have any sales yet? Nope. Any expenses yet? Nope. Any profits? Nope. This is just a balance sheet. Clean and simple. Now we bought some equipment for cash. What happens? 26,000 cash. Well, something happened to cash and something happened to equipment. These are both on the asset side of the balance sheet. Did cash go up or down? No one depends about it this time. Cash went down, we spent the cash, but equipment went up. So if we look at that, cash as an asset went down, equipment as an asset goes up. Assets don't always go up, assets don't always go down. Sometimes they go up, sometimes they go down. But this is on the one side of the balance sheet, on the asset side alone. And there it is. Now, there was another supplies purchase. But one thing I want to mention here on number 3, we spent $26,000 on equipment. How much in expenses have we had so far? Do we have any revenues? Nope. Do we have any expenses? Nope. We're going to depreciate equipment. Depreciate equipment means we're going to take that $26,000 and allocate it. Maybe it's going to last 13 years. That's $2,000 a year. We're going to move that $2,000 a year off our balance sheet, reduce our asset values, and move it over to expenses, and reduce retained earnings so our assets and equity stay in balance. Our accounting equation is cohesive. But we have not had any expenses yet. Even if we bought inventory, we're at Best Buy and we just bought $10,000 worth of TV sets. Cash would go down or accounts payable would go up, liability 10,000 up, inventory 10,000 would go up. Do we have any expenses? You say, but I bought TVs. But you will see that we haven't sold any TVs yet. Until we sell them, we don't move inventory over to the income statement. So when we sell a TV, we get revenue. Say we got a $500 TV that we paid $400 for. Now we've got $100 profit. We don't have $10,000 in inventory expenses. No such category, no such account, no such line item called inventory expense. We're still in balance. Life is good. Provide services for cash. All right, this sounds like a revenue item to me. It also sounds like we got some cash. So our cash went up and our revenues went up. And so did our retained earnings. That's how we're going to keep things in balance. Let's watch that. So we get cash as an asset and revenue from equity going up. So our cash went up and our revenues went up, which means our retained earnings went up, which means our equity went up. Again, that's the big picture that we want to get a feel for and have a decent understanding of. We pay accounts payable. We write a check. Cash is going to go down. Accounts payable is going to go down. Cash is an asset being reduced. Accounts payable is a liability being reduced. Let's see how that fits. The penmanship is much better than mine. Cash is an asset, as we just said. Accounts payable liability. Asset goes down, but so does the liability, our obligation to pay. We don't owe the money anymore. We just paid it. We're done. Here's our income statement. They had a series of more transactions. There's our consulting revenue, 4,200 and 1,600. Rental revenue, all the revenue gets grouped together. All the expenses get grouped together. Rent expense, salary expense, for a net income 4,400. By the way, this is in your book. We have retained earnings beginning at 0. We take our net income of 4,400, add that to our retained earnings. We take $200. They gave us $200 in dividends in another prior screen or prior place. I cut up some of the transactions for a net of $4,200. Where's that $4,200? Right under our balance sheet, right into equity, right into retained earnings instantaneously. You got $4,200 in cash for services rendered. Your retained earnings goes up $4,200 without hesitation. and so does your income statement. So all these are related: income statement to the statement of retained earnings to the balance sheet. Continuing, we now have a balance sheet where assets equals liabilities plus equity. I was actually hired as an interim controller for a company. A friend of mine was an interim president. He's had their books that were challenged. I got there. Their assets did not equal their liabilities plus equity. Definitely a bad sign. That was the first thing I had to clean up. Then I had fun there. We did a bunch of things. It was outside Madison, Wisconsin, high-tech company. Did some cool stuff. Then we have a statement of cash flow. And we have cash flows from operations, investing, and financing. And we'll see this OIF. I'm going to highlight that here on our screen right here. We're going to draw the term, which confuses everybody. OIF. I can't really get a decent acronym for you other than OIF or OIVE. Operating, investing, financing. We'll talk more about that. Okay. But cash flow is king and queen. You can make a lot of profit, but if you have it all in receivables, you can't pay your employees in receivables. You can't pay your rent in receivables. You can't buy from your suppliers with receivables. You need cash. And if you don't have the cash to pay your bills, you close your doors pretty quick. So cash flow is king and queen when it comes to running a business. Let's talk about return on assets. Net income over average total assets. Let me go back here a second. So you got net income, $4,400. If I buy all these assets of $40,400 and we take average, it's a point in time at the beginning, a point in time in the end, divided by 2. That's kind of important. We'll talk more about that. And we take 4,400 out of 40,400. And so we're just over 10%. Return or profit or net income on assets. And by the way, as accountants, we have all these terms that mean the same thing. So when I go in and I start talking about, kill the draw. I go in and I start talking about ROA. This is one form you're going to walk away with today. Return on assets. You take the return divided by, and we'll just put that slash right here, average assets. Remember, return or net income is for a period of time. Well, that's why when we combine an income statement item like return or profit, and we take a balance sheet item like assets, we need to take average assets. We're combining a whole year's worth of returns and a beginning, ending assets, add together, divide by 2, you take an average. But one confusing thing is return is the same as net income, is the same as net profit, is the same as earnings. I use EPS, earnings per share. I ask a net income percentage, net income divided by total sales, net profit, net income. These are all identical terms and they mean the same thing. So return on assets, return on equity, return on average equity is what we need to get. We'd have to average our 2 equity balances. We'll see how that works later on. We're going to actually go into some live financials like Apple, like Microsoft, like Alphabet, Google, and we'll go see what they are directly. We have access to all publicly traded financials, and you're going to need them for your projects anyways. All right, so there's our return on assets. Nike, about 19%. Apple's probably about 22%. Harley-Davidson might be 12%. Walmart might be 4%, as well as Target, 4.5%. Does that mean Walmart's a worse company than Harley-Davidson, or than Exxon, or than Nike, or than Under Armour? Well, performance-wise, Under Armour is doing not nearly as well as Nike. As a matter of fact, last year they had a loss. See, Under Armour, those cool clothes, they're like a Lululemon, they're like a Nike. They make lots of money, don't they? They sell lots. Last year they didn't make anything. They lost money last year. That happens. And then the activities. We mentioned OIF, operating, investing, and financing. And just to give you the overview, the best way to look at that, operations is the normal stuff we do. We buy inventory, we sell it. We make things, we sell them. We've got employees, we pay them. That's all operations, our normal routine stuff we do. We also invest in things. We buy buildings, we buy equipment. When we buy fixed assets, that's considered investments. And sometimes we can buy other companies, not buy back our own stock, but buying stock in another company, that's investing. And then we have financing. There are two ways to finance. We can issue stock, we sell stock, ownership interest, or we issue debt, bonds payable, which we promise to pay back. The downside of bonds payable is we got to pay interest on that whether we make money or not. It's a 5% bond, we got to pay every 6 months, 2.5% of $10 million, $100 million, we commit to do that. If we sell equity, we don't have to pay that. We don't have to declare dividends. As a matter of fact, most high-tech companies pay zero in dividends. And you've got a discussion question that talks a little bit about that. And we'll talk more as well. So this gives you some insight into where we're headed, what we're doing, and again, a little more background on the big picture on financials. And that's what we have to worry about. 3 major types of activities defined: financing activities used to pay for resources such as land, building, equipment to carry out plans. It could be owner financing, non-owner financing, don't worry about that. But financing, OIF, that was the F in OIF, financing, bonds and stock. Investing, acquiring and disposing of resources that the organization used to acquire and sell its products or services, machinery, equipment, vehicles, intangible assets like patents, copyrights. And finally, we have operating activities. And this is the resources, this is R&D, the stuff we buy, the stuff we sell, the storage, distribution, the rent we pay for our storerooms, retail locations, and facilities. And this is all part of the normal operation. Now, the best indicator of future performance is cash flow from operations. You can get financing this year, it doesn't mean you're going to be profitable. You can attract investors this year, it doesn't mean you're going to be profitable. So operating is the best predictor of future performance, is how our operations doing. We sold stuff, we had expenses, we made some money. Next year, we'll probably sell about the same or more, hopefully, maybe a little less. Our expenses may go up a little bit, may go down a little bit, but at least we have a baseline to work from. And we can picture where we're going with this business. So back to OIF, I always have operating first, as does the cash flow statement. Investing second, financing third. That's the overview. That's the chapter. Thank you for your indulgence, and we look forward to continuing onward and upward into chapter 2. Enjoy, and I'll see you at our synchronous sessions if you choose to come. I would welcome your participation. I'll be there to answer questions as we go. Thank you for your time.